a very special guest to make sense, to try and make sense of all that's happening around us. Jim O'Neill, ex-chair of Chatham House, ex-chief economist Goldman Sachs, ex-commercial secretary to the UK Treasury, and probably one of the finest voices to try and explain what's happening around us on the show today. Jim, thank you so much for taking the time out and speaking to us. This is Neeraj here. What do you make of the first order and the second order impact of the tariff war, as we call it now, post-China's retaliation?
It's pretty scary. You have the two economies that have contributed more than 50% of global GDP since the start of the millennium, throwing very large bricks at each other. It is not very good, to put it mildly. And the stance of the leader of the free world appears to be literally trying to throw an even bigger brick in the core operating system of how the world economy and business and financial system has operated since I've been born. So, not surprisingly, financial markets around the world are reacting accordingly.
Most certainly. Now, Jim, the extent of tariffs that US imposed were a surprise, but the way China has reacted as well, it almost seems as if China believes that it spent years fortifying itself against US pressure and now can last longer in an economic war. What does this imply, or what are the implications of this move for world economy? Because other nations, particularly in the EU, may follow suit, even if some of the Asian nations might go out and do a deal with the US.
So obviously, it is all very, very unpredictable as to what each day and week now follows. But first of all, it's important to not get carried away with any sophisticated approach the US has used here. As a number of people have commented, I strongly agree with this. There has not been a lot of thought put into the true meaning of reciprocal tariffs, effectively influenced by his extreme anti-trade supporters. Trump has come up with a system where anybody that runs a trade surplus faces the biggest tariffs, irrelevant of whether they actually had tariffs on the US or not. And so, not surprisingly, the temptation for any other country, particularly those that are the biggest exporters to the US, is to reply accordingly and to do it in a way which hurts the things which have benefited most from this US-led global trade system the past 60 to 70 years. Now, that said, I personally think the Chinese should have waited a little bit, as the Europeans are trying to do, and not least because there could be some scope for negotiation. I think, or I used to think, the current US Trade Secretary, Scott Bessent, is a pretty sensible person that understands markets. And I say that because how many days that we have this kind of huge drop in global stock markets going on, which, as we've seen during the 40 years of my adult professional life, the more they go on each day, the more negative feedback loops they can have into things that were not anticipated. And it's very interesting and worrying that so far in the European morning, and from what I can see from Asian trading, major banks are suffering particularly badly. And if we start to get into that issue, then there's a knock-on effect for bank lending and for real estate stocks, something which might really personally upset the US president. So another reason to wait is at some point, you would imagine even President Trump might decide to change his mind and try and persuade other countries to offer him some kind of way out by a sort of token of some kind of deal. But if he carries on with the tone that he gave in interviews overnight or early this morning, then I can't see any respite in the near term. and you probably will get other countries following some kind of response the way that China did. The most sensible thing to do for the rest of the world, as I tried to say on Friday here in the UK, is whilst the US is the biggest economy in the world, it's not as dominant as the US financial system and the US security support. So in that example, the G6, which is the rest of the G7 minus the US, collectively is the same size as the United States. And the G20 minus the US is obviously dramatically bigger if it includes China and India. And so what I would really encourage, and I think this is already happening, is leaders of the rest of the world that believe in free trade should get together and actually pursue lower tariffs between themselves and actually significant ideas about boosting cross-border trade in services. And if they manage to do that, it would diminish the global importance of what Trump is doing here, and end up just really harming US multinationals and the US's remarkably successful role in post-war economic and global governance leadership. It's kind of bonkers what Trump is doing, in my opinion.
Point taken, Jim, and therefore begs the question, and Harsh also joining in, begs the question as to whether a pullback is likely in your view. Will he flip on the current position he's taken, and if so, how quickly, and will he be forced to, not only from a market perspective, but even from a US consumption perspective and inflation perspective?
Well, he has to, I think Wednesday is the day that the reciprocal tariffs are supposed to come into existence. So obviously 48 hours isn't normally a long time, but in these current markets, as we saw in 2008, as we saw in 2001, and for people like me who were around this business then, as far back as 1987, 2 days when you have this kind of financial market turmoil is a very long time. So I would be surprised if there was not some kind of hint of a shift. I mean, cumulative, we're looking at something like, I think Japan has already entered bear market territory, and many other markets must be pretty close to it, including the United States, which of course opens in a few hours' time. And if you look at what was said by key cabinet members, particularly again Scott Bessent since Friday's close, there's a hint that if other countries really do offer some kind of alternative concession, which could range from deliberately allowing their currencies to rise sharply against the dollar, or some kind of commitment to boosting their own domestic demand and importing more from the US, I would imagine at some point, Scott Bessent would certainly be trying to tell the president, let's call it a day and claim victory, because if we carry on like this, there could be exceptionally strong lasting damage, which will make it very hard to recover from, including for things that are important to Trump's own domestic agenda. And I think, as your question implies, if Trump is really, really, really intent on going this way, then the biggest damage is going to be to the US consumer, because the US consumer has been the single biggest beneficiary of all this mayhem, of all this system that we've had for the past many decades.
And Jim, what should one make of crude and metals at this point? This uncertainty with regard to crude and the global uncertainty creating what it has on in terms of an impact on crude, you feel that justified in a certain sense, or do you feel that you could start to see this wane quickly?
Well, you know, markets are markets, and I would imagine the one thing we're guaranteed for just this trading week is extreme volatility. And the first hint of any kind of backing off from Trump or his advisors, then you will get a big reversal in what's happened since Thursday morning European time or Thursday morning Asian time. And of course, commodities and crude oil have been part of it because, in essence, the markets are very quickly pricing for some kind of recession. And as we've seen, I think in 2020, during the worst of the COVID days, I think the near-term oil contract actually went negative briefly. So, if Trump repeats what he said last night US time or early morning our time again during the day, then if anything, the market declines and the price of crude will accelerate downwards, because we are literally witnessing, if it's left to how it is, of a dismantling of all major global multinationals that have so painstakingly built up to the global relevance they have been for many decades, and they will not be able to cope with this kind of savage shift in the rules of engagement that Trump is effectively trying to impose. What I don't understand is this sort of naive assumption that it's only going to affect corporations outside the US. I mean, a lot of US multinationals are responsible in their own sophisticated roles of causing the US trade deficit. So why they haven't realized that is quite remarkable, in my opinion.
Nilesh Shah, MD of Kotak Mahindra Asset Management, with us on the show as well. Nilesh bhai, great having you on a day like this. Thank you so much for joining in. You and I can afford a smile, but I'm telling you, a lot of people out there are really licking their chops this morning. How bad is this uncertainty, Nilesh bhai, for risk assets pricing?
Undoubtedly, Neeraj bhai. Today, we don't know what President Trump will do. His actions have been fairly unpredictable. We would have never guessed on political side he'll say Canada should become 51st state of US or Greenland should be given to us. On the commerce side, we would have never assumed that he'll be levying tariff as trade deficit with America divided by exports to America. But this is the world in which we are living in. Do remember that the objective of President Trump is appropriate. Even mighty US, the world's biggest, most strongest nation, cannot afford fiscal deficit at 6 to 7% year after year. It cannot afford current account deficit at 3.5% of GDP year after year, despite having reserve currency. The debt to GDP ratio at 125% with unfunded pension liability, clearly they needed to tackle. The objectives are right. The process has been fairly difficult to understand, and which is why this uncertainty is likely to persist. The process which they are following, it will create lose-lose situation for US as well as the globe, and hence there is little hope that it might get reversed before it is too late. In the order itself, there is a clause 4 which says that America is open to negotiation. Vietnam, which allowed China to use their base for manufacturing or actually assembling and exporting to US, has already announced that will make zero tariff. So there will be negotiation, and that's the hope. But clearly that uncertainty is likely to persist as President Trump remains fairly unpredictable.
Right. So can it happen that because of this uncertainty prevailing, and who knows, it could last for a better part of 2025, can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right? Can it happen?
Undoubtedly, Neeraj, but markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always trying to forecast future. As of today, we don't know what kind of tariff will be there on pharma products. Who will bear the burden, manufacturer or the distributor, which has disproportionate margin? But yet market is going to take pharma stocks down, assuming that tariffs will be levied as irrationally as it has been levied on other products.
Nilesh bhai, good morning. Hiral on this side. Let's talk about history as well. I mean, tariffs have been levied by the US in the past. We did see that resulting into a recession. How are you looking at 2025 then? Do you think it'll just be a major impact in terms of lower growth and higher inflation? Or it could be much more leading to recession or something like a Great Depression that we saw? I mean, is it a good comparison?
So Great Depression is unlikely to occur because today both political class as well as central bank are far more cognizant about learnings of Great Depression. To a great extent, Great Depression can be blamed on very, very tight monetary policy of central banks around the world. I'm sure they have learned from the same, and unlikely that they will allow recession to go into Great Depression without taking appropriate action. At the same time, there are equally opposite cases where levying tariff has resulted into recession in US in 1828 as well as 1930. Now, there may be people who may see that this levying tariff is appropriate from the America's point of view because of fiscal deficit, current account deficit, and debt to GDP ratio. Will it create stagflation in US where growth is lower, inflation is higher? Quite likely, that is a possibility. That will lower the global growth. If engine stops of the train, the whole train has to stop. And US is the engine of global GDP along with China and India.
So Nilesh bhai, one aspect that I'm picking up from your conversation right now is how strategically we position ourselves as a country to take advantage of it. So from an investment perspective, which are the sectors that could take advantage of this kind of a tariff war to take business from other countries into us and in turn be buying opportunities for investors?
So one, there is so much of uncertainty that there's no need to hurry to invest. In the hindsight, we may feel, oh, this was a great level to buy. But when there is a storm brewing outside, it's far better to secure yourself and then think of opportunity. Number two, clearly domestic focused sectors will stand out in this storm. Undoubtedly, India's growth can take a hit if global growth slows down, but we will still be a positive growth. We will still be one of the fastest growing major economies. So your portfolio should tilt towards domestic focused sectors rather than international focused sector. Within the sectors which could take advantage of opportunity, as India has been levied little less tariff compared to others, there could be opportunities in textiles and garment. There could be opportunities in footwear. There could be opportunities in some of the pharmaceuticals and chemical sectors and so on and so forth. But please remember, if the American demand itself comes down, then these opportunities will be back-ended, not front-ended. It's not that American buyers will straightway shift from China, Vietnam, Thailand to India. One, their demand should remain consistent. And second, we should have capacity to service them. It's all going to take time. Market does discount future, but it's likely to be more back-ended than front-ended.
Nilesh bhai, difficult days, but thank you so much for your wisdom. Really appreciate, and I'm sure viewers benefit from it as well. Thank you.
We're now joined by Mr. Jonathan Starks, the CEO of FTR, and it's going to be a very interesting conversation because we've seen multitude impacts of the Trump tariffs across sectors. and automobiles as well as the Class 8 truck market will definitely be one of them. Mr. Starks, good morning, good afternoon. Thanks so much for joining us today. I just want to start off the first question on the impact of these US tariffs on the Class 8 truck market. What do you see, at least in the short term, as conditions are right now, that additional tariffs on countries like India as well as the others coming in from April 10th? What impact do you see specifically on the Class 8 truck market because of these tariffs?
So the very first impact is more limited than what could have been in place. The fact that Canada and Mexico were not implicated in the initial set of reciprocal tariffs meant that some of the impacts that could have been most severe for the sort of the domestic North American Class 8 marketplace were less severe. But there are still some pretty significant impacts related to steel, iron, aluminum, that are definitely going to be a negative overall when we're talking about the equipment marketplace, and the fact that we're going through so many disruptive events, whether it's the reciprocal tariffs or what's happening within the North American space with US, Canada, and Mexico, that is going to disrupt the freight transportation markets, which is really what drives the demand for equipment. And if we are losing the ability to grow in the freight transportation space, doesn't matter what the cost implications are going to be for new equipment, we're going to lose demand for building that equipment.
I just want to understand and take this point forward for tariffs, essentially, that now that we've seen not any kind of additional tariffs coming for Canada as well as Mexico, but we see a lot of Indian forging companies essentially have more than 30 to 35% of their standalone revenues to the Class 8 truck market. So apart from these countries of Canada and Mexico, how are you seeing the kind of impact currently from these players across India as well as Europe to the US Class 8 truck market?
The hardest part about all this is that we really don't know, because even though everything has been stated now, we sort of have a baseline we're working from on what the reciprocal tariffs are. Now we're down to a negotiation phase. And so that means that what we see right now could be radically different from what's actually going to be implemented in place here over the next few weeks or few months. So it makes for a very disjointed picture. It's very hard to give a good concrete answer on what this is going to do for the marketplace, which is unfortunate because we would love to be able to give more clarity. But I think what it does highlight is the fact that we're in this period of uncertainty that is going to dampen demand overall. So whatever good positive benefit any country might get from having a better tariff environment relative to China is probably going to be mitigated to some extent just because we're going to be reducing demand in the marketplace.
Now, Mr. Starks, I just wanted to ask you, over the last 6 to 8 months, starting somewhere around September till March, the preliminary figures, of course, it's been a high single-digit drop in sales essentially over the last 6 to 8 months in Class 8 truck market. Could you, just quantify some of the factors that might be impacting due to this? Because we've seen that, fleet utilization have also been lower in this particular time frame, and that's not leading to incremental sales, of course. So what are some of the key factors that, according to you, have been impacting the market over the last 6 to 7 months?
Well, we've been in an extended freight weakness for nearly 2.5 years in the U.S. market. And it's always freight that drives the fundamental demand for equipment. And so the fact that we've been in this weak environment for so long, we knew that we were coming to a spot where we were going to get a weaker environment for new equipment demand. And we're finally getting to that point. The negative downsides of what we're seeing right now is that that weakness could be persistent for a much longer period of time than we would have anticipated that we would have seen going into the start of 2025.
Now, Mr. Starks, just one question also on another key aspect, which was the US EPA norms that was expected to, come in from 2027. Now, we've seen, the heads of the organization speak about delaying those green norms because the current administration of Trump is anything but green, if I can say that. So we were expecting a pre-buy essentially to get triggered in FY26 in essentially the second half of the financial year. Currently, while it is uncertain, how do you see that the Trump administration would maintain these EPA norms going forward, and how critical essentially were these US EPA norms to come in from FY27, because they were expected to be green norms? But how critical do you see them? Because that would essentially determine if they will be implemented or not, right?
So there's two conflicting emphasis that are happening right now. One, engines are actually getting certified as of right now for the regulations that are coming into place at the beginning of 2027. So no matter what, the market is already moving forward and gearing up and preparing for that. If they remove specifically the warranty aspect of the regulation or significantly reduce it, they could limit some of the cost that is going into the new engines. But I do not think that they're going to be able to mitigate the costs of the engines themselves because they have been in development for multiple years, and they're going to be going into certification and going into vehicles starting in 2027. They might be able to delay a period of time, maybe lose some disruption. But the cost impacts are going to be built in over time over the next several years. I don't think there's any way of getting away from that. Even if, from our perspective, there was always going to be a limited opportunity for purchasing excessive units in 2026, it was certainly there. We've removed that completely from our current baseline forecast of the market, just because we think that with the administration indicating that they're looking at this regulation, the fleets then are going to be very hesitant to want to pre-buy equipment. We think that they're going to get hit with those cost increases anyways, but we don't think they're necessarily going to purchase equipment well in advance as of right now. There's an opportunity that it could still happen, but that is becoming rapidly reduced as we move into 2025.
Well, Mr. Starks, thanks so much for joining us today here at NDTV Profit, giving us a comprehensive view of how do you see the current Class 8 market. I know it's an uncertain time, so thanks so much for joining us and giving us a detailed outlook on the same.